home finance hacks. Normally I'm giving you all the tips, the tricks, the methods that are going to help you save hundreds of dollars a month, thousands of dollars over the course of a year, sometimes even $10,000 or more over the course of a year. But in this particular episode, I guess you would say, this particular broadcast, I'm going to be talking more about some things that have been going on in the housing market, in the real estate market, some things that you have probably been aware of, but aren't exactly understanding the effect that it's having, not particularly on you, but maybe on your psyche, on your mindset as well, and some things that you may be missing. So we're going to talk about the value of home ownership. And with that, I do want to say that I have conversations with so many people, whether it be in person, whether it be via social media, that don't see the value of home ownership. They don't see it in the same way that a lot of people, not just myself, but a lot of people even outside of the real estate industry see it. And so we're going to start off by giving you a little bit of statistics. I want to pull this up on my phone to make sure that I read this correctly, because I'm actually going to read it directly from the website that I got this from. So if you don't know what the GAO is the Government Accountability Office. And so the Government Accountability Office released a report, and I'll just read this whole paragraph because it's not that long. So Government Accountability Office released a report, and the report is about rental housing. And this was on May 22nd of this year, 2024. And so the report is based on a review of 74 studies about institutional investors in single family rental housing. And the institutional investors are companies that have enough access to capital that enable them to purchase large numbers of single family rental homes. And so according to the studies, no single investor owned more than 1,000 single family homes prior to 2011. So no single family investor owned more than 1,000 single family homes prior to 2011. However, by 2015, institutional investors own between 170,000 and 300,000 homes. So that's a large range, but somewhere in between there. Now by 2022, so just a couple years ago, 32 institutional investors collectively own 450,000 single family homes. And according to GAO, the Government Accountability Office, the 5 largest investors own nearly 300,000 homes. So the 5 largest investors, institutional investors, own nearly 300,000 homes in the US. Now, think about that for a minute, because like I said, I talk to a lot of people who talk about, it's shifted now, it's better to be a renter, it's cheaper to be a renter. I'm actually going to get into that a little bit later as well, about the actual cost of being a renter, because depending upon where you look at it, it is cheaper to be a renter. So I am going to explain that, but wanted to get these numbers in front of you just so that you know institutional investors are purchasing a lot of real estate. And there's one other article that I want to show you as well, because it hits a little bit closer to home, at least for me, because I live in Metro Atlanta. And so in Metro Atlanta, there are 3 companies that own more than 19,000 rental homes. That accounts for almost 11% of the rental homes in the Metro Atlanta area. So Atlanta is a very large metropolitan city, growing metropolitan city. And in that, 3 companies own almost 11% of all of the single family rental homes in Metro Atlanta, which is a pretty large number considering the size of Atlanta. And so with that, it just goes to show that you have a lot of institutional investors that have over recent years put a lot of interest into buying up large amounts of single family housing. Now, with that being the case, why is it that you have a lot of people who don't see the value of single family homes? Whereas you had many institutional investors, particularly in the pandemic, who were actually willing to pay $20, $30, $40, $50,000 above asking price just to get these properties. Whereas today we have a lot of people who would tell you, oh, homes are too expensive. I'm gonna wait for them to come back down, or I'm gonna wait for interest rates to come back down, whatever the reason may be. You have a lot of people that are waiting, but institutional investors were actually willing to pay more for homes than what they were being listed for. And there was a number of years that a lot of institutional investors were doing that, and they're still holding on to a lot of those properties that they overpaid for as well. So I'm gonna talk a little bit about the science behind that and why they would make that decision, and some things that you might be missing when it comes to home ownership. So when it comes down to it, making money in your home. Well, first I want to say this: when an institutional investor purchases a home, they've got to pay for all the same things that you would if you were a homeowner. They've got to pay for the taxes, the maintenance, the upkeep of the home. If they have a mortgage on that home, they're going to have to pay for the debt that they have on that home, all the same things. So how is it that an institutional investor sees it as an opportunity to pay, in some situations, overpay to purchase a lot of single family homes, knowing they're going to have to pay taxes, knowing they're going to have to maintain, upkeep the properties and everything like that? But you have a lot of individual investors who don't see it as a benefit to own a home. Now, getting back to what I said I was going to mention previously, in the short term, it is cheaper to rent. I'm not arguing that point at all. If we're talking about today, you're going to go purchase a home, or you're going to go rent the exact same home that you could purchase. If you were to purchase that home, it's going to cost you more every month on a mortgage payment than what it would cost you to rent that home in the short term. And that's where these institutional investors actually are seeing things a little bit different than what you are probably seeing them. They are looking at this from a long-term perspective. Real estate is not a short game. I know you have some fix and flip real estate people out there who just get a property, they fix it up, they try to flip it and make a quick 50,000, 150,000, whatever it is on the flip. But to really build and grow wealth in real estate, it is a long-term play. And a lot of these institutional investors are seeing the long-term play, which is why, again, that huge number, over 450,000 homes in the US are owned by institutional investors. Just 32 institutional investors own over almost 500,000 homes in the US, which is crazy, but they're looking long-term. And this is the long-term that they're seeing. When you purchase a home today, let's just say that you purchase doesn't even matter the price. Let's just say a $400,000 home. You purchase a $400,000 home, and let's just say that the mortgage payment on that home is $3,000. We'll just keep the numbers easy. $300,000 or $3,000 for that $400,000 home. Now, that's the mortgage. If you wanted to rent that home, let's say that you could rent that same home for $2,300 a month. So you're renting the home for $2,300, but if you owned it, you'd be paying upwards of $3,000, maybe $3,200, $3,300. But you see the difference, about a $700-800 difference, possibly a little bit more, from what you owning that home versus you renting that home down here. Now, when you own that home across a 30-year mortgage, your principal and interest payments are not going to change. They're going to stay the same, meaning that you're going to pay the exact same amount every single month for the next 30 years for principal and interest. When you rent a home, your rent on average increases 2 to 5%. Whether it's 2 or whether it's 5 depends on the market in which you live in. You might live in a market where rent is closer to 2%. You might live in a market where rent is closer to 5%. But depending upon where it is, on average, every single year, rents increase. So if I have to start off by owning a home and I'm paying this, or I can rent and pay right here, a lot of people opt to just stay here because they say, oh, it's always going to be less to rent. And so they're seeing this, but what they don't see is that long-term perspective of, okay, 2.5% increase next year, 2.5% increase the year after that, 2.5% increase the year after that, or 3% or 5%. Eventually, if you were to have purchased that home after enough years have passed, that mortgage is actually going to be cheaper than what you would be paying to rent that home. It's a long-term play, and that's what the investors are seeing and why they are jumping in and purchasing all of these single family homes. they are seeing that long-term play of, okay, I own it right here, but if I keep this home over the next 10 years, rent's going to continue to increase until rent surpasses what the mortgage is. If they have a mortgage on it, with some of them, they're just paying cash for these homes, so they don't even have a mortgage on these homes. But for the ones who do have a mortgage on the homes, they know that eventually rent's going to surpass how much they're paying on that mortgage, and everything after that is just increasing how much they're making in capital. I know this from personal experience because I am also a landlord. I own rental property. And when I first started renting my property, I had to add an additional like $150, $200 just to make the mortgage payment. But I didn't let that deter me from continuing to rent the property. So I kept renting the property. Rent continued to increase until eventually rent was even with the property, and I was renting it and breaking even. I continued renting the property. Years after the fact, now I'm making a lot more on renting the property than what I actually pay on the mortgage. This is what a lot of institutional investors are seeing when they purchase a property. Even if they have to overpay, you hold on to that real estate for long enough, and eventually that rent is going to catch up and surpass what the mortgage is. And that's when anything after that, you're just making hand over fist money. But that's not the only thing. Another thing is that real estate provides you with a lot of hedge against inflation, because real estate on average over the last 60 plus years has appreciated at a rate of about 4% year over year. So what that means is that if you own that $400,000 home that we use in our example, this time next year that would have gone up 4% or $16,000. So you can just do the math with 5 years down the road, 10 years down the road, how much that home is appreciating year over year over year. So not only are you getting income from the rent, which might be covering the mortgage if you have a mortgage on it, or it's just money in your pocket if you don't have a mortgage on it, your home is also becoming more and more expensive. A little trick that I'll let you in on: if you get to the point to where you need to cash out, or you need cash in your pocket, because real estate is not a liquid place to hold your money, meaning you can't easily pull the cash out. But if you wanted to, or you needed to access a couple $100,000, your property has gone up so much in value that you could actually do a home equity line of credit or a home equity loan. If it made sense, you could do a cash out refinance, but you could do a home equity line of credit, and you could pull $150,000, $200,000 out of your home. By doing that, guess what? You don't have to pay taxes on it because it's considered a loan, and you don't pay taxes on a loan. That's just a tip or a trick for you, that when you have built up so much equity in your home and you're like, I need to access this equity. If you have all of that in stock, let's say you want to sell a couple $100,000 worth of stock. When you sell that stock, you're going to pay capital gains tax on how much you made on that stock from the time that you bought it until the time that you sold it. You're going to have to pay capital gains tax. But if you own real estate and I need to access money in real estate, I can refinance my real estate. I can do a home equity line of credit on my real estate, or a home equity loan on my real estate, access the same amount of cash. Now I have the cash and I still have the real estate. So the real estate's still appreciating for me. I have the cash, it's in a loan. So yes, I do need to pay that money back, but smart investors are only pulling out the cash because they see another investment that's going to allow them to produce even more money. So they pull out 50,000 here, or 150,000 or 300,000 here, and put it to work over here so that it can make them 400, 500, a million, whatever. They're increasing their money so they see a better place to put their money, but they still have the home and they can take the capital and put it to work here. Whereas on your stock, if you were to sell those stocks, you're going to have to pay capital gains tax. So again, it's a good hedge against inflation because your real estate is increasing in value year over year, which is adding to your net worth, adding to the amount of money that you can tap into through that equity. But also you're able to borrow from that without having to get any tax penalties, because you're not getting taxed on that money. So they have this long-term perspective. They, being the institutional investors, have a long-term perspective on the wealth that's going to be generated by owning the real estate. You have to live somewhere. Everybody has to live somewhere. So They have an asset that is needed, and they have a lot of it in a lot of these major cities. It's appreciating every single year, most years in value. Obviously, you have some years where it might take a dip, but if you were to actually look at a chart of home values over the last like 60 plus years, with the exception of 2008, home values have pretty much stayed consistent or increased throughout the time, which is why the average over the last 60 plus years is about 4% appreciation. When you average out even the '08 recession, it's still about 4% appreciation year over year on average. They see that this asset's becoming more valuable. They can borrow from the asset and not have to pay taxes on it. And every year, they are pretty much going to be increasing the rents somewhere between 2 to 5%. So that asset is making them more money, increasing in value, and they can borrow from it without having to pay taxes. That is huge, and that is something that investors are seeing and why they are purchasing a large amount of real estate that's out there. Now, what does that mean for you? I still think that homeownership is a great thing for people to pursue. Now, will you be making money off the property that you own? No. However, you are also not going to have to just continue to pay increases to someone else who is making money off of you. You can benefit from the equity that you have growing in your own home that you live in. But you can also, like I said, eventually having a long-term perspective, you will eventually be paying less money every single month than what you would be paying to rent the same property if you keep that property long enough. Just like I said, with the first house that I purchased, I was living in it, but then I started renting it out. And when I started renting it out, it was not profitable, but I kept it long enough and eventually it surpassed where what my mortgage was. But if I had continued living in that property, let's say I never started renting it out and I just continued living in it the entire time, what I would be paying in a mortgage right now would be very low compared to what rental rates are in that same area today, because rental rates increase. And so it has been to my huge benefit that the property has not only more than doubled in value from what I paid for it, I'm also renting it out for way more than what the mortgage is. And if I wanted to borrow money from the property, I could do that and I don't incur the tax hit because you don't pay taxes on a loan. Again, those are the three things that a lot of investors are looking at. And that's some of the things that I really want you to start looking at and paying attention to when it comes to real estate. And you might be thinking, oh, it's just cheaper to rent. It's cheaper to rent. Try and have a long-term perspective, because in the long term, in the long run, net worth and the opportunities that you're going to have to access hundreds of thousands of dollars of equity can really come to you through the form of home ownership or owning some form of real estate. Even if it's multifamily or whatever it is, real estate is probably one of the best investments that you can have. And this is why a lot of those institutional investors own so much, particularly just in single family homes, because a lot of people think it's just apartments. No, 32 institutional investors own almost 500,000 single family homes in the US. That's huge. Don't overlook this opportunity that's going on right now. There are opportunities out there. I think the market's still changing, and it remains to be seen what's going to happen in the near future. I know it's an election season and everything like that, but the opportunity is still out there and real estate is going to still be needed. So that's all that I have for you. Hopefully it's been hugely beneficial. Go back if you need to and listen to this again, because again, there are a lot of nuggets that I dropped in there that would be really huge, really beneficial for you to implement in mapping out your home ownership journey, because it is something that I do believe should be on your radar and one of your future goals as well, hopefully in the near future. But that's what I have for you. Thank you for taking the time to tune in. Take care, be blessed, and we'll see you next week.